Brad Williams, Frugal Finance, Capital Asset Pricing Model. This has been around forever. Some argue that it's a useless method for computing asset pricing, beta, what have you. Some are going to argue otherwise. Look, it's been around for 60 years, so clearly it serves a purpose. I'll just briefly explain CAPM. The risk and return model that has been used the longest and is still the recognized standard in the majority of most real-world analysis is the capital asset pricing model. While it has faced its fair share of disapproval over the years, it offers a constructive footing for a conversation of risk and return models. Assumptions, while diversification has its appeal in terms of lessening the exposure of investors to company-specific risk, nearly all investors limit their diversification to owning only a few assets. Even large mutual funds are unwilling to own more than a few hundred stocks, and a lot of them hold as few as 8 to 18 stocks. There are two reasons for this unwillingness. The first is that the added benefits of diversification becomes less significant as the portfolio grows more diversified. The 21st asset added will usually grant a much lower reduction in company-specific risk than the 5th asset added. May not cover the cost of diversification, which includes transactions and monitoring costs. Updating information today is a little easier, but in the past, and it's still, for accuracy, you still might need to enter the data manually. And I know from experience, it takes a lot of time and it's expensive. The second is that countless investors and funds trust that they can identify undervalued investments and so choose not to own those investments that they judge to be correctly or overvalued. The capital asset pricing model assumes that there are no transaction costs, all assets are traded, and that investments are infinitely divisible. You can buy any fraction of a unit of the asset. It also assumes that there is no private information and that investors, therefore, cannot find under or overvalued assets in the marketplace. By making these assumptions, it eliminates the factors that cause investors to stop diversifying. With these assumptions in place, the logical end limit of diversification is to hold every traded risky asset, both stocks and bonds and real estate, in your portfolio in proportion to their market value. This portfolio of every traded risky asset in the marketplace is called the market portfolio. Implications for investors: if all investors in the market owns the identical market portfolio, how accurately do investors signal their risk aversion in their investments? In the capital asset pricing model, investors modify their risk preference in their allocation choices, where they choose how much to invest in an asset with guaranteed returns, a riskless asset, and how much in risky assets, market portfolio. Investors who are risk averse might decide to invest much or even all of their fortune in the riskless investment. Investors who wish to take on added risk will invest the majority or even all of their fortune in the market portfolio. Investors who place all of their fortune in the market portfolio and still eager to taking on more risk could do so by borrowing at the riskless rate and investing in the same market portfolio as everyone else. There's a lot of other ways to do this, but we'll stay on track here. These outcomes are predicated on two other assumptions. One, a riskless asset is available, and two, investors are able to lend and borrow at this riskless rate to arrive at their best possible allocation. There are alternatives of the CAPM that permit these assumptions to be relaxed and still come into the same conclusion that are consistent with the general model. What is the market risk of an individual asset? The risk of an investment to an investor is the risk added by that asset to the investor's overall portfolio. In the CAPM, where all investors own the market portfolio, the risk of an added single investment to an investor will be the risk this investment adds to the market portfolio. Naturally, investments moving up and down with the market portfolio will generally be riskier than investments that move up or down less, since unrelated movement to the market portfolio will have little impact on the overvalue of the portfolio when investment is added to that portfolio. Statistically, this added risk is measured by the covariance of the asset with the market portfolio. The covariance is a non-standardized measure of market risk. Knowing that the covariance of Granite Construction with the market portfolio is 55% does not provide a clue as to whether Granite Construction is riskier or safer than the average asset. We therefore standardize the risk measure by dividing the covariance of each asset with the market portfolio by the variance of the market portfolio. This yields the beta of the asset. So beta of an asset I is equal to the covariance of asset I with market portfolio. Divide this by the variance of the market portfolio. Since the covariance of the market portfolio with itself is variance, beta of the market portfolio, and by extension, the average assets in it is 1. Investments that are riskier than average using this measure of risk will have betas that exceed 1, and assets that are safer than average will have betas that are lower than 1. The riskless asset will have a beta of 0. Computing expected returns. The fact that every investor maintains some combination of the riskless investment and the market portfolio leads to the next conclusion, which is that the expected return on an investment is linearly related to the beta of the asset. Specifically, the expected returns of an investment can be shown as a function of the risk-free rate and the beta of the asset. Expected return on asset I is the risk-free rate plus beta of asset I times the risk premium on market portfolio, where E of R is expected return on asset R, ER of M is expected return on market portfolio, and B is beta of asset J. To use the capital asset pricing model, we need these 3 inputs. While we will look at the estimation process in far more detail later, each of these inputs is estimated as follows. The riskless investment is defined to be an investment where the investor understands the expected returns with certainty for the time period of the analysis. Therefore, the riskless rate used may change depending on whether the time period for the expected return is 1 year, 5 years, or 10 years. The risk premium is the premium required by investors for investing in the market portfolio, which includes all risky investments in the market instead of investing in riskless assets. So it does not relate to any individual risky investment, but to risky investments as a class. The beta, which we define to be the covariance of the asset divided by the market portfolio, is the single company-specific contribution in this equation. In other words, the only reason 2 investments have different expected returns in the capital asset pricing model is because they have different betas. Brad Williams, Frugal Finance. See you soon.